Hey there, crypto enthusiasts. Welcome back to another video on Bitcoin Dorks. Today, we're going to talk about a recent trend in the financial industry where banks, venture capitalists, and pension funds that were once crypto-friendly are now steering away from cryptocurrency. As we all know, cryptocurrencies have been gaining mainstream attention in the last few years, with Bitcoin leading the charge. The rise of cryptocurrencies has also led to the emergence of various financial products such as cryptocurrency exchange-traded funds, ETFs, and futures contracts. Initially, banks, venture capitalists, and pension funds saw cryptocurrency as an opportunity to diversify their generate high returns. However, the volatility and regulatory uncertainty surrounding cryptocurrencies have made them less attractive to these institutions. Recently, many banks have been restricting their customers from buying cryptocurrencies using their credit cards. The move has been made to protect customers from losing money on risky investments. Moreover, banks are concerned about the lack of regulation in the cryptocurrency market, which makes it susceptible to fraud and scams. The same goes for venture capitalists and pension funds. Many venture capitalists who invested in cryptocurrencies during the initial coin offering, ICO, invested in cryptocurrency have faced backlash from their customers for investing in risky assets. However, it's not all doom and gloom for cryptocurrencies. While some institutions are pulling out of the cryptocurrency market, others are doubling down on their investments. For instance, large corporations such as Tesla and MicroStrategy have recently made significant investments in Bitcoin, signaling their confidence in the long-term viability of cryptocurrencies. Moreover, several institutional investors, including hedge funds and asset managers, are increasingly investing in cryptocurrencies. The recent launch of Bitcoin futures contracts on major exchanges has also made it easier for institutional investors to invest in cryptocurrencies without holding the underlying asset. The recent trend of banks, venture capitalists, and pension funds steering away from cryptocurrency is a result of the volatile nature of the market and lack of regulation. However, this doesn't mean that cryptocurrencies are losing their original investors. As the market becomes more mature and regulatory frameworks are put in place, we can expect to see more institutions enter the cryptocurrency space. As cryptocurrencies gain more mainstream attention, it is natural to expect that traditional financial institutions and investors will take notice in sentiment among some traditional players towards cryptocurrencies, with some investing in them and even integrating them into their business models. However, not everyone in the traditional financial world has embraced cryptocurrencies. In fact, there are still many banks, venture capitalists, and pension funds that are steering clear of the cryptocurrency market. This has been a topic of discussion in the crypto community, as it raises questions about the future of cryptocurrencies and their potential adoption. One factor that may be contributing to the reluctance of some traditional players to invest in cryptocurrencies is the volatility of the market. Cryptocurrencies are known for their price fluctuations, which can be much more dramatic than those seen in traditionals and bonds. This volatility can make cryptocurrencies a risky investment, particularly for more conservative investors like pension funds. Another concern that some traditional players have raised about cryptocurrencies is their association with criminal activity, because cryptocurrencies can be used to make anonymous transactions. Some have suggested that they are more likely to be used for money laundering, terrorist financing, and other illegal activities. While this is certainly a risk associated with cryptocurrencies, it is worth noting that traditional financial systems are also vulnerable to these types of activities. Regulatory uncertainty is another factor that may be deterring some traditional players from investing in cryptocurrencies. Despite these concerns, there are also many traditional players who are bullish on. Some banks have started to offer cryptocurrency services to their customers, while others have invested in cryptocurrency companies or even bought cryptocurrencies themselves. Similarly, some venture capitalists and pension funds have also started to invest in cryptocurrencies, seeing them as a potentially lucrative asset class. The relationship between traditional financial players and cryptocurrencies is complex and evolving. While some are embracing cryptocurrencies, others are still hesitant to get involved. As the crypto market continues to mature and regulatory clarity improves, it is possible that more traditional players will start to invest in cryptocurrencies. Despite the fact that crypto assets are being seen as a potentially high-growth market by many industry analysts, some fund managers are still hesitant to enter the space due to perceived risks and regulatory uncertainties. One of the reasons why traditional financial institutions have been wary of cryptocurrency is due to the market's volatility. Bitcoin, for example, has experienced massive price fluctuations over the past several years, making it difficult for investors to gauge the asset's long-term potential. However, some market experts believe that this cautious approach to cryptocurrency investment may be short-sighted. As the market for digital assets continues to grow and mature, it's likely that regulatory frameworks will become more established and stable. Additionally, cryptocurrencies could potentially offer investors a level of diversification that isn't possible with traditional assets. Despite the reluctance of some established investors to enter the crypto market, there are still many institutional players who are bullish on digital assets. Firms such as Grayscale Investments and Bitwise Asset Management offer crypto-focused investment products that are designed specifically for institutional investors. Retail investment platforms such as Robinhood and Coinbase have seen a surge in user growth, indicating that interest in digital assets is still on the rise. Overall, the trend of established institutional investors avoiding cryptocurrencies is a complex issue that reflects a range of factors. While some investors may be hesitant to enter the space due to perceived risks and regulatory uncertainties, others are bullish on the potential for digital assets to offer diversification and high growth opportunities. As the market for cryptocurrencies continues to evolve, it's likely that we'll see a range of approaches from different types of investors. That's all for today's video. If you found this information useful, make sure to hit the like button and subscribe.